There is a tax that nobody tells you about when you take a corporate job. It is not on your paycheck. It's not in the interview. It's not in your benefit package. It's invisible. And it compounds quietly for years until the day you realize you have been paying it your entire career. It's called the loyalty tax. It is the price you pay when you invest everything into an organization that has never been designed to invest everything back into you. Today, I'm going to name it clearly so we know what it is. Because once you see it, you cannot unsee it. And once you understand what it has cost you, the only logical next move becomes obvious. So what is the loyalty tax? Listen closely. So the loyalty tax is not about bad companies or bad employers. This is not a cynical episode about corporations and that they are evil. So most of the leaders I work with have a genuinely good relationship with their companies. They respect their teams. They believe in the mission. They are proud of what they have built. The loyalty tax has nothing to do with whether your company is a good place to work. It has everything to do with where you have invested your compounding assets. Here is the tax in plain language. Every year, you spend building expertise exclusively inside one organization. That expertise becomes more valuable to that organization and less portable to the market. Every relationship you build through your company's network is a relationship that exists in your company's orbit, not yours. Every insight you develop, every framework you create, every system you design, it belongs to the institutional record, not your personal market position. So you are building equity that you do not own. That is the tax. That's it. And most senior leaders, they have been paying it for a decade or more.
I want to take a pause for a second and talk about your confidence, right? You got the experience, the results, the credibility, but when it comes to putting your voice out there, fear creeps in. Who am I to do this? Does that sound familiar? That's imposter syndrome, and it's keeping you small. My coaching is about breaking through that, helping you turn your expertise into content, conversation, and coaching that builds real influence in your industry. So if you're done hiding behind titles and ready to lead with your story, head over to connectingwithcreatives.com/coaching and let's get started. I'll see you soon.
Now I want to talk about 3 different types of accounts. I want to give you a framework for thinking about where your professional equity actually is sitting. So think of it as 3 accounts, and the first account is your organizational account, your job account. This is everything you have built inside your company, your reputation, your relationships, your track record, your institutional influence. That account is full, it's overflowing. You have been depositing into that account for years. But here's the catch. You cannot withdraw from this account on your own terms. The company controls withdrawal. Now, the second account is your market account. This is your external reputation, your published thinking, your positioning in the broader industry, your ability to generate consulting conversations, advisory opportunities, and income independent of any single employer. Most senior leaders, this account is nearly empty, not because they lack the assets, because they have been depositing everything into account number 1. So the third account is your leverage account. This is the account that generates optionality, the ability to choose your next move rather than to react to someone else's decision about your future. The leverage account only fills when the market account is active. And the market account only fills when you start publishing your expertise externally. Most leaders have a full organizational account, an empty market account, and 0 leverage. That is the loyalty tax in balance sheet form. Now, what a decade of loyalty actually cost you. Here's the breakdown. So let me make this concrete because I think that the abstract version lets people off the hook. Now, if you have been in corporate for 10 years at a senior level and you have not built an external platform, here's what that decade of loyalty has cost you. The relationships that would generate consulting, conversations exist inside your company's network, not yours. You have no external authority signal. If someone outside your industry search your name right now, they would find a LinkedIn profile, almost nothing elsewhere. You have no parallel income, and everything you earn is dominated in one currency, your employer's continued decision to pay you, and you have no optionality. If the company restructures, if the market shifts, if your role gets eliminated, you are starting from zero in a market that has never heard of you. This is a decade of compound loyalty with almost no compound return. The only way to start changing that math is to begin building the market account now. Now, let's talk about how to stop attacks. Here's the practical shift we have to make. You do not stop being loyal to your employer. You do not dial back your performance. Don't do that. You do not blow up your career to go build something from scratch. What you do is start making parallel deposits. For every hour of work you invest in building your company's institutional knowledge, you make a smaller but consistent investment in building your own market knowledge. You record the insight, you publish the framework, you bring on a guest whose conversation builds your market network. Over time, those parallel deposits compound. The organizational account stays full because you are still doing excellent work. But now the market account is growing too. And the leverage account is beginning to build. You are no longer paying the loyalty tax exclusively. You are starting to collect compound interest on your own assets. Now, let's talk about the podcast as the tax reversal strategy, right? Podcasting, podcasting, podcasting. So, podcasting is the most efficient mechanism I know personally for reversing the loyalty tax. Here's why. Every episode converts into internal insight into a public asset. You are taking something that currently lives only in your institutional record, and making it discoverable by the market. Every guest conversation converts a company adjacent relationships into a personal market relationship. The guest knows a peer and a host, not as someone who works at a company they happen to have a connection with. Every episode that gets indexed by a search engine, shared on LinkedIn, or mentioned in a conversation is a deposit into your market account that did not exist before. So 12 months of consistent episode is 52 deposits. At the end of that 12 months, you have a body of work. You have relationships. You have a market signal. You have options. That is what reversing the loyalty tax looks like in practice. So you did not choose to pay the loyalty tax. Nobody explains it when you take the job, but now you can see it. And now you have a choice. You have a decision. You can keep making deposits exclusively, right, into an account you do not control, or you can start building the parallel account that compounds in your name, regardless of any company decides. So the link to start that build is in the show notes. I will see you there.